When on earth it is rude going to find a button? Everyone, let me screen this question out loud on your behalf. In the short term, the Nasdaq is showing signs of stabilizing, but as for storage, don't hold your breath just yet. You can only blame the storage sector for filling inflation expectations in the first place. Now the market has to liquidate your leverage positions just to pay for more expensive physical storage chips. Classic. In fact, last night's price action already gave us a strong wave of display. The Nasdaq held its ground last night, saved by the mega cap tech heavyweights, so it didn't completely spin out of control. However, the semiconductor sector puked over 2%, hitting extra trades nearly 9%. And SpaceX broke its IPO price intraday for the very first time. So my intraday call is that the Nasdaq will likely undergo a time for space correction exhibiting intraday pullbacks and choppy range-bound consolidation, with the overall center of gravity drifting slightly higher ahead of the mega cap tech earnings. Within the AI space, the divergence will widen. Mega cap tech platforms will remain relatively resilient, while any rebound in storage and high beta hardware will be treated strictly as a technical relief rally for now. The market hasn't abandoned the AI thesis. It's just refusing to blindly beat up anything and everything with an AI tag to valuation haven anymore. TSMC's freshly printed earnings report is the perfect fundamental reality check for this phase. Blockbuster earnings, solid guidance, and no material cost to capex, combined with ASML upwardly revising this outlook, it proves at least one thing: the demand for AI compute, advanced nodes, and advanced packaging remains rock solid. So there's no need to be overly bearish in the medium to long term. The AI sector currently lacks the ingredients for a systematic collapse, but the short-term tape is an entirely different beast. TSMC delivered a stellar report, yet Asian semiconductor names still got hammered. That tells you everything you need to know. The market isn't pricing in a drop in industry demand right now. It's punishing overextended gains, overcrowded trades, and excessive leverage. This is a pure positioning flush. This pullback has indeed washed out a lot of leverage, but make no mistakes, the deck is not completely cleared. There are still trapped backholders and hot money looking to scalp the bounce. The moment the tape flash green, these players will likely dump their shares and run. So right now, the AI sector is playing a game of musical chairs. Capital is fleeing high beta for storage and hardware plays and seeking shelter in mega cap tech platforms with clear earnings visibility and bulletproof cash flows. Trump needs market stability ahead of the midterms, and Fed certainly doesn't want to see a sudden liquidity shock. By crowding into mega caps, institutional money can dodge the high beta volatility while keeping the broader indices afloat. So personally, I don't view this sector rotation as a bad thing. When everything was ripping higher in unison, stacking valuations and leverage to the moon, that was dangerous. This high to low rotation, which flushes out weekends and forces capital to refocus on actual earnings and cash flows, is actually a healthier setup. However, the real headache tonight isn't earnings, it's the macro backdrop. The ultimate bottleneck remains liquidity. Sure, the cooling June CPI and PPI prints ease immediate rate hike anxieties, but that isn't liquidity easing. It's just less tightening, and the market has already full priced that in. With Korea hiking rates, the US lapping on tariffs, water teasing balance sheet run-up expectations, the biggest wild card is still the US-Iran geopolitical tension. Military operations expand and crude prices refuse to cool down. The market will instantly pivot back to trading inflation resurgence, hawkish rate expectations, and even a potential acceleration of quantitative tightening. A rate hike makes money expensive. QT expectations make the market fear that money is disappearing. When these two forces collide and treasury yields spike, the high valuation, high leverage tech sectors will be the first to bleed. Furthermore, New York State pausing certain mega data center projects serves as a stark reminder. The AI infrastructure build out doesn't have a permanent green light. It faces real constraint in power cost regulatory policy. Yet Trump's immediate pushback shows he's still banking on AI CapEx, data centers, and big tech to prop up the economy, secure jobs, and support the stock indices. Cloud AI planning its IPO investor meetings in the coming weeks sends the exact same signal. The AI narrative is alive and well, and institutional capital hasn't abandoned the ship. However, the disconnect between sentiment and fundamentals is about to get much uglier. This is why managing your position sizing and leverage right now is absolutely paramount. Okay, this is just my personal analysis, not financial advice. And also shout out to EBC Financial Group for sponsoring the content.